Hi, we're talking about Your Money Matters on NDTV Profit, and my name is Mathew. Now, all through this week, I want to talk a little bit about how women should manage their money. And look, this is not those kind of tropey conversations ahead of Women's Day. I'm using it as an opportunity to speak about something that I think we should speak about in any case. And before you think about it being a stereotypical conversation, let me reassure you, it is not my intention for me to have a broad brush approach to this kind of a conversation. Joining me today to talk about whether or not women should have a slightly different lens or approach to money management, I'm joined today by Megha Malpani, who is CFA and partner of Zvest Financial Services. For those of you who don't know, Megha is part of a husband-wife duo that manage their firm together, and they're both financial advisors. Megha, that's why I thought that you would be the perfect person to speak to about this. And like I said at the start, this is no intention to have stereotypes or broad-based conversations. It's simply a curious question. Should women look at financial planning differently because the way that they think that their needs are significantly different?
Thank you, Alex, for having me here. And, I'm glad we are having this conversation. So the thing is that the principles of investing are gender neutral. Compounding does not recognize gender, nor does risk. We have evolved to calling a batsman a batter. And I think it is high time we stop saying men investor and women investor and start talking about investors as a fraternity. Right? To my mind and knowledge, I don't think there is a capability difference, but it is more of a confidence gap, which has built in over decades. We have encouraged our women to go and work and get financial freedom, but financial freedom only happens when they become allocators of capital, right? And there is some very interesting data which is kind of visible if you look at the data which has been published by AMFI in 24 and 25. Close to about 1 in 4 investors, mutual fund investors, are now women. They hold close to about 30% of the total SIP book. And once they start investing, the holding period for them for over 5 years has increased from 8% to close to about 20% as of March 2024. So, which goes on to prove that when they actually enter this space, they are naturally better investors because they demonstrate discipline and they have generally a lower impulsive trading or a speculative behavior. I think we as a whole, and I'm glad we are having conversations like this, as an industry, we need to kind of acknowledge our role. We cannot, speak to them last in the meetings. We cannot just assume a conservative risk profile for them. We have to try to talk in a language that they understand so that the confidence which has been getting outsourced till now doesn't get outsourced, because it is important to realize that when they become allocators of capital, the household balance sheets improve. It works not just better, better for that household, but it also leads to improved economic architecture for a country as a whole.
Very well put. And in fact, my second question relates to that allocation, because let's face it, Megha, the points that you've raised are incredibly encouraging. But having said that, you still see a majority of women tend to prefer the traditional sources of investing. And I'm talking about gold. I've spoken to and obviously this is not based on studies, etc. This is anecdotal evidence, so I may be wrong. You interact with a lot more people, so please correct me if I have the wrong perception. But I meet a lot of women who tend to prefer gold. I meet a lot of people who tend to prefer fixed deposits and relatively more conservative options. Is there a need for there to be a conversation and for women themselves to realize that they need to allocate towards growth assets more, to have more risk in their portfolio, and not really to the extent of saying, oh, you need to look at small cap funds? That's not what we're saying. We're talking about having equity.
Right. Alex, you're correct. Absolutely correct in your observation, because the last available data shows that India as an economy holds close to about 27,000 to 30,000 metric tons of gold, the households that is, whereas the RBI holds just about 880 metric tons of gold. So you're absolutely right as far as your observation is concerned. But I think if we address two most important points today, and we're able to drive home this point, a lot of our work will be done, which is one, helping them understand the future value formula, which has three variables: principal, rate of return, and time. It is important to understand that principal is a finite source. You cannot borrow or steal to invest money for yourself. Return is something over which you have absolutely no control of. And time is the only lever you can actually play to your advantage. That's point number one. And we women have, a structural compounding disadvantage because there are shorter cumulative work years. Pay parity is actually only a boardroom discussion. We start investing later, and more often than not, we inherit someone else's risk appetite. Another thing which we absolutely,
Wow.
fall prey to is inflation. While the general print inflation ranges anywhere between 3 to 5% depending on when you are checking, but let's understand some of the major nuances, right? Education, which any woman would want, for in the best manner possible for her or child, if she has a child, is to the extent of close to about 10 to 12%. For K-12 category, and for higher education, it is to the tune of 8 to 10%. Medical inflation is to the tune of 11 to 12%. Add to it the fact that, you typically are going to outlive men as per data by at least 3 years. So if you do not take care of inflation, do not invest in assets which actually create value, your money is not compounding, it is just saving in crude terms to say, right? So the point being that and also the point that we sometimes forget that gold, silver, real estate, because they feel safe, familiar, tangible, we often resort to them, but they also have inherent volatility.
Sure.
Just to give context, over the last 10 years, gold has had a volatility of close to 12%, silver has had a volatility of close to 24%, whereas Indian equities have had a volatility of close to about 16%. The only difference here is visibility, because this, is evident to you on your screens every
Sure.
day. You feel it is more riskier. But the right strategy would be to have some portion which, is kind of suited to your time horizon and liquidity needs, and have them in some kind of a blend to ensure that while you're kind of protecting capital, but you're also protecting purchasing power. If you're able to address these 2 points, I think a lot of our work will be done.
Okay, all right. And we talk about a model portfolio, not to say that this is a recommendation for anybody to follow, but Megha, I'm going to prod you or push you to give me what you think is a model portfolio for a woman in her 20s, so that she can make the best start possible. And I'm hoping that this goes out to those people, and if even 100 or 200 people start doing that, I think that my purpose will have been served. But before we do that, I want to address two age cohorts. One is mothers, either people who are planning or people who are going to have a child, or young mothers. How do they ensure dealing with that period where, in all probability, they're going to have to take a break from work? Sometimes people even choose to not work for a little while. And I'm not just talking about the maternity benefit. And how do you ensure that that transition takes place properly?
Right. So, if you're somebody who is deciding to go the family way, it is important that, you take care of certain expenses, which will be incremental expenses. Understand what your corporate health insurance cover provides for. If there is a shortfall, probably start parking those funds into liquid funds or arbitrage funds, depending on your tax. Decide clearly about work continuity. This is a very honest conversation you need to have with your partner and with your family members, because ambiguity in income planning will create long-term distortion. it is also important to understand that, having a child increases your expenses considerably. So, enough assets are parked for the short term to take care of the additional expenses that will incur. Arbitrage funds, etc., can be easily considered for this. Also, remember that when the child comes into your life, you add him or her to an insurance plan within timelines. Um, Also, once you have the child, please ensure that you start investing for the child as early as you can. All that you need to do is open a bank account, and remember that time, which will play for your child's advantage, is going to give them a lot of optionality in life going forward. Some parents, including myself, prefer to kind of have investments for our children separate from
Yeah.
our own investments, because that kind of ensures that, there's a lot of mental comfort that their education will be taken care of. And also, I think a very, very important point under consideration is that remember that do not impose your risk profile to your child's risk profile, because he or she has, close to about 15 to 18 years before higher education actually starts coming in. And they can definitely have much more exposure to growth assets like that we were discussing earlier. So that is an important variable to consider here.
Sure.
In yeah.
So I do want to just stress, okay, so that's important points that you're raising, Megha. Also, the importance of not focusing on the recency bias, which is something that will tell you that gold is an incredible asset to invest in, right? And you've just talked about the fact that over the last 10 years, it's had volatility. There were periods of time when gold did absolutely nothing. So I know that that's a tough conversation to have with somebody today to say, hey, you know what, gold is amazing. You should be investing most of your money in it. That's a strong argument to make. But the second cohort, Megha, that I want to talk about, and you mentioned part of this, right? I love that you pointed out so much data. Women tend to live longer than men. This is not simply statement. It is a statement of fact, and it's based on data. Even more so because there is a gap usually between partners, particularly in that generation that is currently at the senior citizen level. So how should women at that age ensure that they have continuity and that they're planning for their old age?
Right. I think, Alex, the work for this has to be done much earlier. So, you have to be a part of financial decision making as early as you can, because, if you have not done it when you were 25, 30, believe me, it is extremely difficult to do it when you're around 65. And, or, when there has been a case of an accident in your life, right? As you rightly said, because of the age gap and the sheer fact that they outlive men by 3 years, there will come at least a period of close to about 8 to 10 years when they will have to take care of their finances alone. The good idea, in my view, to do, once you probably are towards the phase of retirement would be to consolidate your investments. We have come across so many cases where investments are so much fragmented that even the investors don't know where the money is lying. Simplify. Complexity is not a great thing to have as in when you're approaching retirement. Prioritize on liquidity, because you don't want to run helter skelter for your own money, which you have built over periods of hard work. Ensure that you maintain sustainable withdrawal rates. Sometimes it becomes extremely important to understand that, you cannot be taking so much money out of the portfolio that there comes a point in time where you outlive the portfolio, because that becomes extremely difficult situation to be in. Ensure estate clarity is taken care of, and there are enough conversations that you have early, so as to ensure that the assets are passed on to the next generation as seamlessly as possible. I think my only piece of advice here would be that in later years, clarity is more valuable than product sophistication. So please ensure that you are only in assets that you completely understand.
Yeah, important. And in fact, if you're of a certain age and you're thinking of giving your partner something this Women's Day, then perhaps write a will. Make sure that it's absolutely clear what you intend to do with your assets. You are safeguarding their future by doing that. Megha, just a last point, and I think that this would be an indicator to somebody tuning in who wants to share this with their partner, who wants to take this advice up by themselves, which is, what is a model portfolio for somebody in their 20s that is at the start of their earning potential so that they can lay the foundation for the future?
Right. So, Alex, this is, a difficult question to answer because
I
we do
understand.
not have the entire context. But, I'll give you some points to consider, which is that, your portfolio must reflect your objectives. It should not have inherited comfort of somebody else. The most important thing to do would be to ensure that your liquidity and time horizon drives your allocation. So if you're somebody who's kind of looking at higher education a few years down the line, ensure that funds are parked accordingly. If you're somebody who's kind of ensuring that you're building a long-term portfolio, first build a foundational layer where you have insured for your contingencies, where you have done your risk transfers in place, and then park that much a portion into equity, which you can leave for the longer term, which would at least be a period of 5 to 7 years. The greatest advantage that you have is time, and even if you make some mistakes along the way, I think that is all right because the capital is limited and you have a lot of time to course correct it if need be. uh, my recommendation would be that ensure you at least have close to about 6 months of savings parked into liquid instruments. And once you have that, start building the long term portfolio. A good strategy for the initial years would be looking at hybrid funds, good flexi cap funds. If you're young, also consider some dollar denominated assets because they also not they just do not add diversification, but they also add good business ideas into the in comparison to the companies that we have here in India. So yes, a certain combination which matches your liquidity and time horizon could be looked into from this perspective.
Okay, all right. Megha, thanks so much for taking the time. Pleasure speaking with you as always. And happy Women's Day in advance.
Thank you, Alex. Thank you for having me on, and thank you for the wishes. I wish your viewers and your entire team at NDTV a very happy International Women's Day.